financial. This is an overview to give you a sense of how the financial markets work, but it's related to the firm itself. So when we look at this, the financial markets are how outsiders view the company. The company is very concerned about their market performance for a number of reasons. One, executive compensation in firms is tied to the stock performance. So the better the stock price does, the more money the executives make. Next thing, if you go back and remember, shareholders elect the board of directors, the board selects management. One of the things the shareholders are concerned about is increasing shareholder value, which is stock price. So some of this is survival of management. It's also the ability to secure additional capital if you want to grow. It's an ability to use equity for growth and acquisition. So it's a source of funding. So both people have an interest in it. From an internal perspective, it helps determine the optimal capital structure. Remember, weighted average cost of capital. The ability to raise capital. Ability to have exterior measurements of how much the firm's value is. Okay. Ability to create shareholder value. It's the basis for compensation. It understands and helps us understand the impact of financial decisions that we make. It helps create sustainability and it creates brand identity. So this is why internally the firm is focused on the market price. If you're taking notes for the last quiz, you're going to find that this may be a question, both this and the external focus. External focus is decision making by stakeholders, providers of capital. It's opportunities for trading, opportunities for investment, to express a view of the market and to manage risk. So these are the different focuses of the different participants. Let's stop for a moment and say, what are the financial markets? Well, the market brings together those that have something to sell with those who want to buy something. Price is determined between a willing buyer and a willing seller. The media regularly refers to the financial markets. These are multiple venues that buy and sell financial instruments. Now, when we talk about price between a willing buyer and a willing seller, that may be the same. We may put the same value on something, but at times we have different points of view. And our different points of view can influence how we place value. So we'll keep looking at that, and that's what makes a difference. So markets bring together those that have something to sell with those who want. They are venues, if you will. Now, some markets are public and some are private. Public markets are available to everybody. You and I and anybody can participate in these markets. They're run by firms and they facilitate trading. And firms, trade for clients and their own accounts. Now, in public markets, there tends to be a transparency and fairness. So if I'm involved in a buying on a public market, I can see what the bid ask is. And there's fairness. I'm not a one-on-one. It's a very open process. There are regulations to produce the consumer, large and small. These are the Securities Exchange Commission has rules. New York Stock Exchange has rules. Nasdaq has rules. CME Group has rules. These are just some examples of some of the public markets. Now, we've talked about this before, but the Securities and Exchange Commission regulates companies that sell securities to the public or are listed on public exchanges. This can be equities, can be debt, instruments. The focus is really on disclosure, making sure companies have disclosed information that's usable, needed, and relevant to the user of the financial statements to make decisions, whether that's about lending money, whether that's about investing in the company, merging with the company, etc. The financial reports, which we talked about. Annual is the 10K. Quarterly is the 10Q. Issuance of stock, which is a S1. And ensuring compliance with regulations. They protect the investor from a disclosure point of view and information point of view. They do not evaluate the firm. Okay, that's an important distinction here. Primary compared to secondary market. What do you need to know? Well, you need to know there's two. That there's a primary market and secondary. Primary, a company directly receives the cash. Okay. A secondary is transactions between investors who don't receive cash. So the company doesn't receive cash. So that when I'm trading or investing, I'm buying it from somebody else, not from the company. So a primary offering is also known as an initial public offering, or an equity offering. So what that does is it is between the company and the purchaser. Secondary transactions are between investors. The issuers don't receive any cash. But it's important, as we said before, since shareholders own the company and elect the board, it's a basis for determining value and for compensation. Also provides access for future access to capital. Now, let's take a look at how market.
If you listen to the financial news, you hear about the Nasdaq stock market all the time. But have you ever wondered what goes on behind the scenes in an electronic stock market like the Nasdaq? Today we're going to go inside and learn how people and technology come together to make trading so easy and efficient.
Nasdaq is an electronic stock exchange. Essentially what that means is we have customers who can enter orders. Nasdaq is the matching engine to match those buyers and sellers.
In the matching engine, there's an entry for all the stocks listed on the Nasdaq stock market, the New York stock market, and the American Stock Exchange, about 8,000 stocks. And the matching engine keeps track of all the buy and sell orders for all those stocks. When a buy price and a sell price match, the computer puts the buyer and seller together and makes a trade.
So if there's a buyer willing to buy at a price that a seller is willing to sell for in any individual stock, the matching engine executes both sides of that trade.
Around the matching engine are thousands of other computers that handle all the incoming orders, all the data feeds that Nasdaq sends out, and so on. All of this computing power lets the Nasdaq platform handle amazing volume.
At any given moment, we see transaction rates of about 200 to 250,000 messages per second. We're taking anywhere from 2 to 250 million orders a day. Overall, we execute about 20 million transactions per day.
Nasdaq uses something called the transaction bus to handle all of these transactions.
The transaction bus is the way that all the other machines communicate with the matching engine and vice versa.
The 20 million transactions represent billions of dollars exchanged every day, making Nasdaq the most active market in the United States. So that's how the Nasdaq stock market works. I'm Marshall Brain, and that's how stuff works.
The economy is a lot like the weather. People talk about it all the time. And if you listen carefully, you'll hear adults throw around terms like stocks, bonds, and dividends. To get a better understanding of what all the chatter is about, Nicole went down to the heart of America's financial district.
This is Wall Street, home to the largest money market in the world, the New York Stock Exchange. Behind these flag-draped columns, billions of dollars change hands every working day. It's where fortunes have been made and lost in a seemingly endless cycle. Founded in 1792, the New York Stock Exchange is one of the country's oldest institutions. It's home to over 2,000 companies.
We provide individuals with opportunities to invest in companies and businesses that have great ideas.
Gordon Brown has worked here for more than 40 years. He's even written a book for teens about investing. So, where to?
We're going to go right over here and we're going to start in the main room.
The stock exchange is basically a giant electronic marketplace.
And in a marketplace, you have buying and selling of goods, much like going to a store, buying groceries and other things. Well, that's what happens here. Now, the New York Stock Exchange is the facility where this buying and selling takes place. This is where the investor, the buyer, and the sellers come together.
What they're selling and buying are shares of stock. Stock gives people like you and me an ownership interest in a company. If the company does well, you can make money. If it does badly, you can lose money. So if I wanted to buy shares of a company listed here at the New York Stock Exchange, someone down there has to sell them to me.
If you look directly at the posts, these posts have panels. And under each panel, there is a DMM, a designated market maker. It is his responsibility to trade the stock. There are also individuals who are walking around who are brokers. These individuals receive orders electronically, and then they go out buying and selling for their customers.
So with all that's going on the floor, all the stocks, all the different companies and firms, is one individual supposed to be responsible for everything and know exactly what's going on anywhere on the floor?
No, what you'll find on the floor of the stock exchange is that the individuals really work as teams.
Gordon explains some of the specialized terms that people here use. For example, the bid is the price someone is willing to pay for a stock. The ask is what someone wants to sell it at, also called the offer.
In this case, right now, IBM has a bid of $126.35 and it's offered at $126.37. So somebody's willing to pay $126.35, someone is willing to sell it $126.37.
So when the bid was only $126.35 and the offer or the offer was $126.37, that's only a 2-cent difference. Is it really all that significant?
Yes, it is, because sometimes those who are bidding and offering are bidding and offering large amounts of shares. If it's one share I'm buying, it's only 2 cents. But if it's 10, 20, 30,000 shares, then that 2 or 3 cents adds up a lot.
Sometimes to millions of dollars. Here's 2 more definitions. If you believe the market is going up, you're a bull. But if you think the market is going down, you're a bear.
Frank.
Investing in stock gives you the chance to partner with some of the greatest business people in the world.
I don't know Bill Gates. I've never had the pleasure of meeting Warren Buffett. But guess what? Through stock ownership, I can profit and benefit from their ideas.
But investing involves risk. Unlike savings in a bank, with investing, you can lose money. That's why experts recommend that you don't invest all your money at one time. Rather, invest a small amount, but do it on a regular basis, say every month. If history is a guide, over the long haul, you'll come out on top. So instead of a bull, perhaps the statue here should be a turtle. Slow and steady wins the race. For Teen Kids News, I'm Nicole.
That last video was a little bit dated because very little trading actually occurs on the New York Stock Exchange. It's all driven through computers and technology. Who participates in the financial markets? There's individual investors who are saving for retirement, education, other goals, or simply to make money. Businesses participate to raise money. Then there's speculators who just want to see if they can make money, having different views of others. Then there's institutional investors. These are pension funds, trusts, endowments, banks, mutual funds, and exchange-traded funds. So they really each have a different view of the market and are trying to achieve different things. So that's sort of who participates, and they all have a point of view that's different. When we look at it from a couple of different perspectives of who's involved. In this chart, which I did take from Kaplan, looks at things from a couple of perspectives. There's different buyers and sellers. Okay, and so when we look at the marketplace, we got the buy side. These are portfolio managers, analysts, tradings, middle market. These who are buying. Then we have those on the sell side, which are structuring deals, investment banking, market data. They're trading, sales. So it's on the sell side. Then we have corporations that sell. The CFO, the Treasury, investor relations are part of this, cash management, corporate finance, and the FX desk. how are they going to trade? If they have foreign operations, they have a desk that trades foreign exchange to manage the risk which we talked about. Other players are insurance, private equity, underwriters, risk management. So we look at this, and I want you to pay attention to buy side, sell side, because that's going to keep coming back. These are some of the words that you will look at. But everybody's involved in the market, but as you can see, there's different roles. So exactly where are these markets? Today, they're worldwide and connected electronically. Major centers in the world are New York City, London, and Hong Kong. Every country has a financial market. And there's something called broad market indicators. And these indicators give you a view of how the market is doing overall. The S&P index, Standard & Poor's 500, is probably the most common in that it represents 500 of the largest companies. Then there's the 400, next 400, which are mid-size, and 600 in small size. So what this does really with about 1,500 companies, these three indices give you everything, a good piece of the market, well over 95% of the market for publicly traded stocks. So it's the S&P 500. Then there is Nasdaq, which we looked at how Nasdaq makes money, but Nasdaq are all the stocks traded on the Nasdaq exchange. Do we have others? Yes. We have the Dow Jones, but that's only 30 stocks. So that really doesn't give us a broad market view. It gives us 30 stocks. We have the Russell 3000, which if we look at the Russell 1000, top largest 1000, make up 92% of that, and the next 2000 only make up 8. There's the FTSE, which is the London metric, the DAX, which is the German, the Hang Seng, which is in Hong Kong, and the Shanghai Composite, which is in China. Now, let's just take a brief look at how the S&P 500 works.
Hello, I'm Raj Gupta, Chief Financial Officer of the American College of Healthcare Trustees. In this segment, we will review the S&P 500. When people say the stock market is up today or down today, they are usually referring to the Dow Jones Industrial Average or the Standard & Poor's 500 Index, commonly referred to as the S&P 500. The S&P 500 Index was launched on March 4th, 1957. However, historical values go back to January 1928. While the namesake is 500, there are typically more than 500 companies in the S&P 500 Index. As of May 31st, 2018, there were 505 companies in the index. One key difference between the Dow Jones Industrial Average and the S&P 500 is that the Dow Jones Industrial Average is a price-weighted index, whereas the S&P 500 is a market cap-weighted index. Market cap is defined as stock price times the number of shares outstanding. Hence, the largest 505 companies with regard to market cap are included in the S&P 500 Index. This is why the S&P 500 Index is often referred to as a large cap index. The combined weight of the top 10 companies in the S&P 500 Index exceeds 20% of the index. The top 10 include names such as Apple, Berkshire Hathaway, JP Morgan Chase, and ExxonMobil. According to S&P Global, the S&P 500 Index captures approximately 80% of the available market capitalization. If you wanted to delve deeper into the remaining 20%, you want to examine the S&P 400 Index, which is a mid-cap index, and the S&P 600 Index, which is a small-cap index. Together, the S&P 500 Index, the S&P 400 Index, and the S&P 600 Index make up the S&P 1500 Super Composite Index. The S&P 1500 Index captures approximately 90% of the U.S. market capitalization. One other note, the S&P 500 Index considers float adjusted market capitalization. The float refers to shares that are floating rather than outstanding. It excludes shares that are not available for trading, such as those held by insiders. Hence, the float adjusted market cap is almost always lower than the total market cap of a company. The value of the S&P 500 index is calculated by dividing the sum of the market capitalization of all constituent companies in the S&P 500 index by the divisor. The divisor is proprietary. On May 31st, 2018, the S&P 500 closed at 2705.27. The sum of the float adjusted market caps of all the companies in the S&P 500 index was 24,156,345,300,000. That puts the divisor around 8.9 billion. And so that's an illustration of the S&P 500 index. You can invest in the S&P 500 portfolio using exchange-traded funds.
It gives you a little bit of an insight into the S&P 500. As you can tell, it is not an easy calculation, but understanding the difference between the weightings becomes important. So that's the indicators that we talked about: Nasdaq, FTSE, DAX, the Hang Seng, Shanghai. Then we move on to bond market, fixed income. And in those, the indices are broad market, aggregate, U.S. government, treasuries by term and rate, U.S. corporate by term and rate. And those are measured by Bloomberg, and they're the Bloomberg indices. From a historical perspective, these were the Lehman Brothers, and you might have heard about them, but Lehman indices. Then it went to Barclays, and now it's the Bloomberg indices. Where do you get market information? A lot of it, as I said, is transparent, and you can get student accounts, practice accounts at brokerage firms that gives you information. But the major sources that we get information from are things like the Wall Street Journal, which comes in, you can either get it on hard copy or you can get it online. It gets news is updated and financial information on a lifetime basis. We have the Financial Times, a London publication, which gives us the European view. We have Bloomberg. For those of you that are interested, we have Bloomberg terminals here at the school, and you can become Bloomberg Essential certified and have access to all of that information. Then there is CNBC, which is a network, and it is based in New York City, and it's on all during the trading day. Gives a lot of information. Then there is somebody like Kramer who's out there. Then we have Bloomberg has information, but they also have a radio and television network. If you want to some morning get up and listen, go to Bloomberg Radio Live, listen to Tom Keene and Jonathan Farrow. It's a good show in the morning and gives you a good sense of what's going on, much more in depth than CNBC, which is still great. And then there's things like Smart Alpha, where you can get a lot of information. I subscribe to it. Some of you may already subscribe to it. You can get a lot of information. So this is where we get information from. Now, there's a lot of participants in them, and I mentioned before that when you look at the sell side, these are companies that are trying to drive business. And when we look at these, they're the big banks, the investment banks. So when you hear investment banks, that includes JP Morgan, Citi, Deutsche Bank, RBC, Credit Suisse, Societe Generale, Morgan Stanley, Barclays, Merrill Lynch. These are people who are making markets, who are trading, selling for their account, for others. They're doing investment banking. They're arranging transactions, helping companies raise money. So they're investment banks. Then there's analysts. And analyst research, what they do is they obviously analyze. Most of them follow a small number of companies and they build models to project results. They speak with customers, suppliers, expert networks. They create financial estimates, price targets, and recommendations. So they're analyzing. A lot of the stuff that we have already looked at is the foundation of what analysts do. And when we look at Wall Street analysts, there's investment bank, research firms, etc. Some of it's summary information, but some of it is public, meaning it's available to everybody, and others of it you pay. And here's an example of some companies who do that: Cleveland Research, Sabrient, Thomson Reuters, Morningstar, S&P Capital. So these are some of the bigger names. So now I want to just go through, when we look at investment research, there's different points of view. When we look at it, they all provide in-depth analysis of companies, industries, and the world economies. That's what they do. Timely, in-depth analysis of companies. They develop amazing expertise in a specific industry or product. And they're held accountable for research and recommendations. So that's what if we think about those things, that becomes the overriding theme of what they do. Then we have sell side, which is oftentimes under investment banking, and then there's the buy side, mutual funds, asset management firms, banks, insurance companies. They hire research analysts or buy information to determine their investment direction. Okay? So when we look at it, and I want to show this here, is this gives you an example here. That's who's on what side. But the revenue generator becomes important. So if I'm the buy side, I'm going to get compensated based on a management fee and information, a paid information fee, or the performance. If I'm on the sell side, I'm trying to drive business to the company, and I'm going to my firm, for example, JP Morgan, Bank of America, or any of them, my commission is what's going to make the money. Investment banking fees, I'm trying to drive business. The customers can be on the buy side. If I'm a buy side analyst, are individual investors, corporations, trust, mutual funds, etc. On the sell side, it's institutional investors, retail investors, and corporations. But the one is driving business, one is not. The nature of the research is decision intensive, high level of accountability, broad coverage base, where on the sell side it's more information intensive, industry expertise. The key, though, is how you make your money and what you're trying to achieve. So the sell side, what do? They analyze research. They report financial estimates, price targets, buy and hold recommendations. It's focused on most big firms. You have a specific niche or sector of companies that they follow closely. The goal is to be first to close the deal, convince the investor through the research to trade through the firm's trading desk. Earn money based on the commission. Okay? Position traders, sales traders. So it's about selling. So when we start with this, where do we get some of this research? Well, summary level, we get it at the Wall Street Journal, sell side websites, and brokerage firms. We can even find out who covers the company when we look at their website. Let me just show you a little bit about where analysts, let me take a minute and just show you a couple things where analyst recommendations come in. So I'm going to search for STLD, which is the company I've been working with all semester. And I put in the symbol, the four-letter symbol, which is STLD for that. And I'm clicking. And what comes up is this page here, which gives me a chart. We'll talk a little bit about that as we go along. Some key data. Most recent news about what's happening in the company. And then we can go down to the bottom and we actually see research and ratings. So what you see here is what the estimated earnings per share are. But if I click on more, what I find is a couple of things. One is we can see here where the analysts from earnings give you a quarterly. Here's where the actual earnings per share are. Okay. And then the range is what was the analyst saying. And as you can tell, it's been pretty tight except for here. And now again, you got $1.28 is the consensus, meaning that's what people agreed to, $1.24. So you can see that earnings trends, okay, 3 months ago they thought they're going to make $1.46 a share. Now 1 month ago the consensus is $1.39, and now it's 128. And 3 months ago, the full quarter 19 went from 128, 125 to 124. So what we have up here, if you're looking, is we have 11 analysts are rating it as a buy, 5 at a hold, and none have an underweight or sell. And that relates in an overweight when you base it on the number of points that are given here. So basically all you need to know is it's either buy, hold, or sell. Some companies use overweight, some use underweight, and you can see that most people at this point are saying it's still a buy with 5. What they're estimating the stock target price for the next 12 months, it ranges between 34 and 59. The average is 46.54. The median is 48.50. Current price 29.74. So if we see this, based on what the analysts are predicting, this stock has a lot of room to run. Okay, so now let's go over and look at some of our other companies that you've been working on. The first one let's take a look at is TAP, which is Molson Coors. So let's take a look here, or same thing, and we're going to go over to more. Okay, now we got something a little differently. We're seeing, again, for the fourth quarter, earnings being a little lower than they had been forecasting, up for the first quarter. Target price, again, ranges from 55 to 85. Median of 73, average 73. Average is 73, median is 73 versus 56. Looks like that. But let's just take a look at what's different. Is in the last one, if you remember, there was a lot that there weren't any on the bottom. But here, one analyst is saying sell, 7 are holding, which is a lot more on a percentage basis, 1 overweight, and 9 are current. So we get a sense that we can find that. Let's now put in the other company, which is O'Reilly. Okay, there's a lot more analysts following O'Reilly. 13 are buy, 1 is overweight, 8 is hold, and 1 is underweight. Now, one of the things I do want to note when we look at these is this is generally the sell side analysts that are reporting this. So if you look, earnings look like they're going to be a little higher than they were 3 months ago, not by much. And if you look at the forecasted 1-year target price, ranges from 292 to 410, 370 median, 363 average, and it's at 341. So that's where we can find some of that information. Now let me just go over again to Steel Dynamics. And again, and I'm keeping this up just so that you're following. When I do this, I'm going to go to Investors. And when I get there, I'm going to find Analysts. And these are the analysts that cover Steel Dynamics. You can see Bank of America, you find the name, BMO, Capital Markets. These are the people who follow it and provide some of those ratings. So hopefully this gives you a little better insight, and we'll move forward from there. Demand, they can issue more stock. And trading in the open market means liquidity. Okay, this is a key thing. It can let you, because you can buy and sell, it enables you to use it for employee compensation. It's also a little bit of prestige when we look at it. What's the process? Well, you underwrite the offering, and that's where you use one of those investment banks that I talked about, and they promote the stock and facilitate the sale of the company's shares. The prospectus is the registration statement, the S1, SEC Form S1, and it describes the issue and the issuer. So it's a little bit like the 10K that you've looked at, but it's from here's where they've been, here's where they're going. Then there's a red herring. Preliminary prospectus is available while you're still waiting. Then there's a quiet period that the company can't talk about it during a waiting period. Next thing is there's the road show. which is a presentation that the investment bank goes out and puts on shows, road shows, to try to convince investors to buy that process, to buy that company. And then there's the actual time that you go public and the stock is issued. So let's just take a brief look at what an S1 looks like. And again, very similar.
As the saying goes, ideas are a dime a dozen. Acting on an idea, though, can make all the difference. Say you turn your vision into a startup. It starts small, then it gets even bigger. Then it gets even bigger. Until one day, you may get to decide it's time for your company to go public. IPO stands for Initial Public Offering. It's the very first sale of a stock issued by a company on the public market, which essentially means you're turning your private company into a public one. So when it's private, a company is normally owned by a small number of investors. That usually consists of people like you, your friends, or parents, plus professional investors like a venture capital firm. Once the company goes public, you're opening up that business to be owned by a large number of people. In effect, the firm goes from being owned by just a few people to potentially tens of thousands of shareholders. To commemorate the event, most stock exchanges hold a ceremony of sorts. At the New York and London stock exchanges, you'll ring the bell. At the Hong Kong Stock Exchange, you'll strike the gong. So why go public? Well, going public raises a lot of cash for a company. With that money, it becomes easier to scale and grow, invest in infrastructure, and attract top candidates. Plus, there's the bragging rights you get from being listed on a stock exchange. It's important to note that large companies can also stay private too. IKEA, Mars, Aldi, and State Farm are just some examples of massive companies that are private. After all, going public isn't a simple process, normally taking about 4 months to complete. The company will start with finding what's known as an underwriting firm, typically an investment bank or several. If and when the firm takes on the job, they put up the money to fund the IPO, essentially buying the shares before they're actually listed anywhere. The firm works with the company to determine what type of security to issue, an offering price, the number of shares, and the optimum time to bring a company to the public market. In the US, they also handle registering with the US Securities and Exchange Commission, which makes sure all of the financial information has been disclosed and is accurate. Then you're finally good to go. The underwriter's goal is to sell shares to the public for more than it paid the company. After all, that's how they make their money. But going public can also mean a nice payday for the business's founders and early investors. You often hear about people becoming millionaires or even billionaires after their company goes public. Here's why. If you've worked at a private company that's intending to go public one day, sometimes part of your compensation is given through equity, part ownership of the firm. It's a way to hire talented people without a lot of cash up front. And if the company does go public, you get a piece of it at its new valuation. Here's an example. When Snapchat went public in 2017, its founder, Evan Spiegel, scored big. Spiegel got a stock grant of $636 million when the company went public. The following year, he sold more than 2.6 million shares. The sale of his stock was equivalent to $50 million. The number of companies going public is constantly fluctuating. Globally, 1,764 companies floated in 2017, a nearly 50% increase since 2016, and the most IPOs since 2007. 189 of 2017's IPOs were in the US, a 70% increase from the year before. A few of the biggest IPOs in history include Facebook, Visa, and General Motors. And in 2014, Alibaba smashed the record with its debut on the New York Stock Exchange, bringing in $25 billion. All that said, going public has its drawbacks. Publicly traded companies are subject to oversight by regulators like the US Securities and Exchange Commission. And once you list your company on an exchange, you're not just reporting to yourself anymore, you answer to all your shareholders. If you don't make them happy, you can be sidelined or even fired from the company you founded. Hey guys, it's Upton. Thanks for watching. For more